primarily value. We measure the market right now to be about 2% below our estimate of fair value. So that would equate to a projected return of 10 to 12% over the next year.
Jack Ablin, what do you think of that? Are you in the camp that says that the market can continue to move that way?
The only valuation metric that I could look at, or anyone could look at, to argue that perhaps the market's fairly priced or cheap would be forward earnings, and that's because we've got forward earnings projected at roughly 26% higher than it is today. And so investors are somewhat skeptical that that 26% isn't sustainable. If you look longer term, however, valuation, EBITDA to say cash flow, or cash flow to EBITDA, I should say, trading in the 90th percentile of its historical range. Really, the only time that we've seen levels higher than right now would be the tech bubble. So I would argue if the market's going to go up 12% from here, it's, in my view, not going to be valuation. It's going to be something other than valuation.
Craig, respond to what Jack just said. He's taking you on.
Well, we never use PE ratios or those simplistic price to any type of one variable. We compute intrinsic value. We take earnings, we project them growing into the future, and discount them to their present value. So when we compute intrinsic value, we find the market to be about 2% below our estimate of fair value.
I mean, Jack, there could also be the argument that, I mean, if you're comparing valuations to the bubble, corporate balance sheets are in much better shape these days versus the bubble. It's almost unfair to compare the valuations now of corporate America to what they were back in the bubble, considering the health of the economy and the health of the corporate balance sheet. That aside, though, Jack, where do you put your money right now? It sounds almost like you're underweight stocks, or you pulled money out, or where do you stand?
No, we're not underweight, but I would say I'm holding positions that are currently in place. We've got valuations, in my view, negative, fundamentals positive, technicals positive. Where the opportunities are right now, I would say the only sector that we see that could actually make some decent money over the next 12 to 18 months would be master limited partnerships. This was an area that got completely tattooed on a valuation basis. They're trading below their 25th percentile of their historical range. Fundamentally, they still haven't fully caught up to where oil prices currently are. And momentum relative to cash is pretty strong. So you take all three of those ingredients, and not to mention, of course, the 5 to 6% dividend yield that they pay, that could be a good place to be. The other side, the flip side, REITs. I think REITs are pretty negative across the board. Valuation's expensive, fundamentals not fully there, with rates drifting higher, and technicals that sector's broken down. So that would be my long short. In terms of equities, like I said, I'd steady as she goes. International certainly trading at a discount to U.S., emerging even more. But there's no catalyst there yet to say, now's the time to get in.
Did I hear you right, Jack, where you said that the only sector you like right now in terms of value are MLPs? Quickly, yes?
Yeah.
Okay,
yeah.
So Craig, I assume Jack has that rather dour view that there's only one sector that's going to make you money, basically, but you see it differently. What sectors do you think are going to perform the best, given your outlook of 10 to 12% gains from here?
Over the last 9.5 years, the 5 best performing sectors have been consumer discretionary, financials, information technology, industrials, and healthcare. We're still in the same bull market for the next 1 to 2 years at least, and it will be that same leadership continuing.